Good evening, class, and welcome to our advanced taxation class for today. Tonight, we will be taking the calculation part of the topic oil and gas taxation. Oil and gas taxation forms an important part of your ICANN examination. So we're taking the calculation part. This is advanced tax. Oh, sorry. This oil and gas taxation. So today we'll be doing calculations. All right, so without further ado, let's go straight to the first question we're going to be taking. Let's look at this question here. It's a typical exam type question. Question number 1. Odiok Oil Producing Company is engaged in petroleum operations. Now, let me stop so far. We're reading and analyzing at each line. Now, how do you know this is an oil and gas taxation question? You'll see the word oil company, oil producing company, petroleum operations, upstream oil segment, oil company, upstream. Now, a company can be doing both upstream and downstream. But when you are calculating the tax, you need to separate the upstream activities from the downstreams, and you will need to tax them separately. And you know that the upstream activity is on actual year basis, while the downstream activity is on preceding year basis. All right, so let's read. Odiok Oil Producing Company is engaged in petroleum operations, so that's upstream. The following information are extracted from the books of account of the company for the period 1st January to 31st December 2013. So it's always 31st December. So now this is 2013. What does it tell us? It tells us that the year of assessment is 2013. Now, one thing about oil and gas taxation is you have to put at least 3 zeros after your Naira sign. Sometimes you may need to put million after your Naira sign, but the list is 3 zeros because they are heavy figures. If you remove the 3 zeros, the figures will be so long in trillions that you may not be able to, sometimes you may not be able to see how to pronounce them. Just 1 minute here. Let me fix something. Now, because we said that the company is giving us their activities for the period of January 1 to December 31st, 2013, and we said because this is actual year basis, the year of assessment is 2013. So that's one thing we need to know. Now, we'll read down, this is the A part, value of oil sold. It's either going to be exports and domestic. So we have exports, we have domestic, and these are all in Naira. Normally by practical, it is being done in dollars. But because you are going to be reporting it in Nigeria, because this is a Nigerian company, it has to be in Naira while we're doing it in class. All right, so deduct product costs. All these are some of the things that are deducting. Now we have other relevant details. Royalties on domestic crude oil, intangible drilling costs capitalized, capital allowances, and we now have here posted prices of crude oil is 30 naira, $30.20 per barrel at the standard API gravity of 300. Now, when we are seeing posted price, this is the price free on board at the ports, and this only concerns exported oil. This posted price concerns only exported oil. Now, this is the price per barrel. So if they have given you the price per barrel, it means they will give you the number of barrels that was sold. Then, if they have given you the standard API gravity, this API gravity depends on the sulfur content of the oil. If they're giving you the API gravity at, this is not 300. Okay, this is 300, fine. Now, this is 300. What I believe, what I mean here is 30 degrees, not 300. So I think this is a typo because API is in gravity. What I think they wanted to write is 30% and not 300. Okay, for every degree decrease in API gravity, the standard API gravity, below the standard API gravity, the posted price is decreased by 0.05. The reverse is to increase the posted price. Now look at the crude oil being exported during the accounting period. This is the number of barrels. So this is what we're going to use. And look at the API gravity. It's not 260, rather this is 26 degrees. API is measured in degrees. And so I want to believe that that's a typo. We're going to treat it like this. Even if the solution, assuming if the solution takes it as 300 and 260, we will not mind, we will treat it as 30 and 26. The principle is the same. Now look at the exchange rate. 1 naira is equivalent to $1.50. Profits from petroleum exported or sold locally are taxable at 85%. So I'll come here and make it 85%. Loss brought forward is $1 million, naira, sorry. Required, we are asked to find the chargeable tax payable. Now, one thing you should know about petroleum upstream sector is you ask yourself, is this company a JV company or is it a PSC? Okay, so it may not also be a JV. So the thing you will ask is this a PSC company or a non-PSC? So a non-PSC could be a single operator. It could also be a joint venture. So the thing we should watch out for is if it is a PSC, petroleum sharing contracts or production sharing contracts. If it is a PSC, you will see it somewhere in the question. You will see them talk about production sharing contracts. You will hear them talk about deep inland basin. You will hear them talk deep offshore. So when you hear things like that, you know they're also referring to the production sharing contract. If you see nothing of that sort, then you assume that it is a non-PSC. So this is a non-PSC. We'll treat it the way we treat our JV. Now, one thing again you should check, they gave us our exported, this is what they extracted in their books. They gave us exported costs, 50 million. Now, do we take their book at face value? No, we will have to check if this is correct. If it is correct, fine. If it is not correct, we discard. How do we do that? Now let's see. What's the name of the company again? Odiok Oil Producing Company. Odiok Oil Producing Company. Computation of chargeable tax for year of assessment 2013. So this is done. So the first thing you will do, okay, so this is what we are going to do now. We are going to put our 2 Naira sign. So this is the revenue. How do we get the revenue? So we'll start with, this is revenue. How do we get the revenue? Export sales. We are going to do a calculation on export sales here. First of all, we are going to look at how many barrels. How many barrels? The barrels is 3 million barrels. So this is 3 million barrels. Now, at what dollar price? We don't know the dollar price yet. So let's leave that place blank. Now, what is the exchange rate? The exchange rate, so as we are doing, crossing it out, taking the 3 million barrels, our exchange rate is 1 Naira is equivalent to what? $1.15. Now we want to convert everything to Naira. So if 1 Naira is this, therefore $1 will be 1 Naira over 1.50. So that's what 1 Naira, $1 would be. So this is in dollar. We want to convert to Naira. It will be 1 over 1.50. So that's our conversion from dollar to Naira. So now the thing is, what will be here? We don't know here. So we will now go there. Let me do it in the third here. So this is workings. So workings number one, posted price. So what's the price we are going to use? Now, standard API is $30 at how much? 30.20. $30.20. All right. So what will happen now is they said for every fall, because there's a fall now. Let's see the fall. Exported oil API is going to be 26 degrees. So fall in API is going to be 4. So this API is going to be 4. That is the fall. So it means that we will now look for what's the value of the fall. Value of fallen API. We will now say for every, or let's say it here. So we've taken this. For every degree decrease in API gravity below the standard API gravity, the posted price is decreased by 0.05. So for 1 degree, it will be decreased by 0.05. And now there's 4 degrees times 4 degrees. So what would that be? 4 times 5 will be 20. So it will be 0.20. So that's a fall. So that's a fall in API gravity. So you will reduce the posted price. So therefore, posted price of exported oil will be 30.20 minus 0.20 will be 30.00. So this is the price we are going to be using up there. So this now is 30.00. Okay, so now let's calculate, and when we finish, we'll put our value here. So what do we do? All right, so let's shift the calculator from our figures and let's calculate. 3 now, because I'm going to remove 3 zeros, instead of writing 3 million, I'll write 3,000 to account for the 3 zeros I've removed. 3,000 multiplied by 30 times 1 divided by 1.50. You see, it's 60,000. And this figure, they wrote here 50,000. So you see, you don't need to take whatever they use. You need to work out yours. So you see here, we are giving 50,000. But in actual case, in actuality, it was 60. Now it is not this 60. This is 50. And that's what we calculated is also exported. It's supposed to be 60. If we add it with 10, it's supposed to be 70. So let's do the right thing. So this is going to be 60. Then domestic sales, we have it as 10. Okay. So if we add them together, this should give us 70,000, 70 million. Now, is that all there is in income? Is there all there is in income? Let's see.
Question, please.
Let's see, there are no other income. Balancing charge. Balancing charge looks like an income, but we'll not take it at this point now. We have loss brought forward. So I'm seeing the comments. Somebody have a question, please ask your question.
Yes, so I just wanted to ask. The way we calculated, the export, the revenue, or yes, is there a particular formula? Because I know you first of all calculated something to get 30. Like, is there a
That's the formula in
formula?
this. There's no formula. That's the way you do it. There's
I
no
know,
formula.
but like what I'm just for us to remind to be able to remember.
And you just know the principle. The principle is get the posted price, get the API gravity, get the posted price and its equivalent API gravity, which is the standard. Bring the actual, the API actual. If the API exported is higher than the standard, find the difference. If it is lower than the standard, find the difference. Now, they will tell you this language for every degree rise or low or fall in standard API, they will give you the corresponding increment or decrement. They must give you. This one, they give us that for every 1 degree rise or fall, it is 0.05. Multiply the 0.05 you have here by the difference. So we did it and we get 0.20. Assuming this was 36 and not 26, we would have added this 0.2 to 30.2. But now it's a fall. So we will need to reduce because the language here it says for every degree decrease in API gravity below the standard, so 26 is below 30, the posted price, which is this, will be decreased by this. So assuming that it was 29 instead of 30, we'll simply say 30.20 minus 0.5. But because it is 26, we would multiply this down by 4, which is the difference between 30 and 26, and reduce it from this. That's the principle. So there is not just a formula where we will not say posted price is equal to standard price. If you want to create a formula, it's something you can create a formula, but there is no formula. So I can say, okay, we can derive our own formula here, and we can say posted price. So from what we just did, it's equals to standard price plus or minus increment for plus or minus increment value times rise or fall. So that's what we just did. So this is our posted price, which was 30.20. We said plus or minus. If it's an increment, we say plus. If it's a decrease, we say minus. But it was decrease, so we put minus. What is the incremental value? 0.05. What is a rise or fall? It's simply 30 minus 26, which is 4. 4 times 0.05 is 0.20. 0.20, if you take it from 30.20, it gives you 30. If you want to write it as a formula like this, there is no where they get formula like this, but you can design your own formula. But I think it's best you just look at the principle like this and understand the principle where there is no formula. All right, so let's look at we see that there is no other income. You need to check well. There is no income, no income, no income, no income. Look at this, no income. All these are deducts. All right, so the next thing to do is this is the gross income. So this is the gross income from operation. I'll call it from ops. That's operation. Then the next thing is to deduct section 10 allowable deduction. You don't need to quote section 10 in case you don't remember that it is section 10. You will not be penalized. Just simply say less allowable deduction. But since I know it is section 10, I just go here and say less, not deduct. I'll say less section 10 allowable deduction. Now, let's be looking at them one by one. Production cost is 2,000. So we take production costs 2,000. So production costs. Now note here that I'll write it here. 2,000. The next one is transportation. Now, transportation here, we need to be careful. This is just ordinary transportation for running around of the business and not transportation of the oil. There's a difference between transporting of the oil to final destination. Yes, transportation up to the port is allowable. But if you are doing a transportation business and you are getting revenue from transportation, that is not upstream. If also the transportation is transporting it through the channels to the refinery, it might also mean another thing that is not upstream business. So, but this transportation here has to do with maybe small transports we do for the company for running around in the business. Even if you travel, air transportation, land transportation, this is not transportation of the oil itself. And I said it could also mean transporting the oil from where it is produced to the port. That's allowed. So this transportation is allowed here. I'll say transportation. Let me say transport costs. I think it was 1,000. So we've taken this. Then recurrent administrative and overhead expense. Meanwhile, you need to be careful if there are other things related to the other relevant details. We didn't say that. So we'll come here, recurrent admin and overhead expenses. That's 500. See, recurrent admin and overhead expenses. That's 500. So what am I seeing? It's not 500. Sorry, sometimes you may need to be ruling these things here. So this is to this. This is here. This is here. This is here. So that means this should be here. No. Should be this. Doing. So this is 60. When we deduct this 3,000, okay? When we deduct this 3,000, that is what gave us this 57. We need to be careful of these figures. Let's rule. Let's rule. Okay, so this is supposed to be net profits. This is supposed to be depreciation. This is supposed to be carbons, custom, fixed assets. This is this. This is here. We get the figure. Now we have this. So now, how did we get 41? It is supposed to find that figure. It's hidden. This is 60 minus 60 here minus 3,000 is 57. 57 minus 16. That's why we got the 41. So this 16, this is what make up the 16. So let's get this 16. Let's see what make up that 16. Let's start 500 plus 50 plus 250 plus 200 plus 12,000 plus 150 plus 50 plus 250 plus 50 plus 25 gives us 16. Okay? Then I know what happened. All right, so all these things here are administrative and overhead expense. I thought that this was a line item. So recurrent and admin expenses. Let's see. The first one is salaries, 500. Salaries, let's say 500. We have here bank charges and interest 50. Bank charges 50. You write it well. 50. The next one is general overheads. 250. General overhead 250. Interest on bills payable 200. Interest on bills payable 200. The next one is royalties and producing rentals 12,000. Royalties etc 12,000. Non-productive rent 150. Non-productive rent 150. Loss on disposal of fixed assets. Now, this is not allowed. Why? Because these fixed assets, this loss was not made from operations. This is sale of asset, which is not their business. So this 50, as well as this depreciation, are not allowed. So we'll go to custom duties. Custom duties. How much is that? 250. The next one is harbor duties, 50. Harbor duties is 50. Okay, so we have royalties on, on domestic sales. This is just royalty and producing rentals. This royalty on domestic sales. This was not captured. We're going to bring it 2,000. Royalties on domestic 2,000. So the rest are not expenditures that are operational in nature. So we'll do all of this now. Let's add this. So let's start. So we have 500 plus 50 plus 250 plus 200 plus 12,000 plus 150 plus 250 plus 50 plus 2,000. That gives me 15,450. 15,450. I'm going to write it here. 15,450. Now, all of these are supposed to be your allowable deductions. So let me add all of these here. 15,450 plus 3,000. It's going to be 18,450. 18,450. Now I will call this one allowable deductions excluding TET. Now TET, which is tertiary education tax, is supposed to be an allowable deduction. So we must allow it. It must also be an allowable deduction. So we need to find TET. So our TET, tertiary education tax, as at 2013, it is 2% of accessible profits. It's 2% of accessible profits. So what it means here is this. Our accessible profit here is supposed to be 70,000, supposed to be 70,000 minus 18,450. This is supposed to be our accessible profit. But the truth of the matter is, our accessible profit of 18,450 is not complete because we have not removed TET. And TET is 2% of accessible profit. Now, because TET has not been removed, we don't have, if you minus this 18,450 from 70,000, we are not having 100% accessible profits because a 2% TET is included in your result. Then it means that for you to get TET is going to be 2 over 102 times all of this figure. Why 2 over 102? Because we are looking for 2 out of 102. This thing is 102% of your accessible profit. That is the only way you can get your TET before getting your accessible profits. That's the only way. Otherwise, you won't get your TET correct. We will do a test for it. Now let's look at it now. So just know the golden rule here. 2 over 102. Now that TET is how many percent now? 2.5. It's going to be, if depending on the year, it's going to be 2.5 over 102.5. If our TET is 3%, it's going to be 3 over 103. As at now, it is 2%. So it is 2 over 102 times, let's look at the difference here, 70,000 minus 18,450. This 51,550 is not 100% accessible profit. It is 102% because a 2% TET is inside. We will now say multiplied by 2 divided by 102. So that will give you 1011. So we approximated it to the nearest 1011. Your TET is 1011. So we'll write it here. 1011. So when you do that, you add these two together. Let me add 18,450. It becomes 19,461. 19,461. So this is your total allowable deduction. So I'm going to put it here. 19,461. So instead of me putting it here, putting it down here, so we're going to remove this from 70,000. So this is your accessible profit. 100% accessible profit. So we are going to be doing, we're going to use this like this, remove it from 70,000. We have, I've done the wrong thing. 70,000 minus 19,461. 50,539. 50,539. Now let's test. If we look for 2%, now not 2 over 102, if we look for 2 over 100 of this, we should be getting this. Let's see. Times 0.02. This is the same thing as 2 over 100. So did you see? 10,101. So that's the only way you get your TET, by doing it this way. Now, this is the major thing they are testing you on in your deductions. One, will you remember that TET is an allowable deduction? Second, will you remember to do 2 over 102 of your gross income minus all the allowable deductions at this time? Whatever you have, you add it to the allowable deduction you've gotten before to get a final allowable deduction from which you get your accessible profits. You can on your own then test to see if your TET was correct. All right, so TET is done, accessible profit is done. Now we have accessible profit. What do we do? The first thing to do is to bring if there's a balancing charge, we bring our balancing charge. No, first of all, let's bring our loss relief first. Loss relief. Loss brought forward. What is the loss brought forward? We have a loss brought forward here of 1 million. I'm going to bring it here. Let me just put it here. 1 million. Now let's say balancing charge. Balancing charge 500. Okay, so balancing charge is 500. Now we are going to be doing something. This is going to be what? $1 million minus 500. This is 999. Let's just do the calculation. 500 minus 1 million. 999,500. Oh, 1 million is 1,000. Sorry. So 500 minus 1,000. Sorry, what am I doing? Let me look at it again. Okay, this here under 3 zeros. This one is captured under 3 zeros, 500. This one is just quoted here. So So this is just going to be 500 here, because that's the difference. So let's bring it down. It's just going to be 50, 0, 30. Okay. Now the next thing to do is to bring your capital allowance. Now you need to calculate capital allowance separately. Your capital allowance. All right, so we are told here we have capital allowances we are as follows. We have this intangible drilling cost capitalized is intangible drilling costs capitalized. I think because of the word capitalized, it's not allowable. I will need to cross-check and verify that if some books allow it or not, but because of the word capitalized, we didn't take that. So capital allowances, we are given this, we have given balancing charge, we've treated balancing charge, so we'll not bring it as again. So bring capital allowances 20,000, charge for the year plus 20,000. Unrelieved brought forward, okay, let me say this capital allowance brought forward 16,000. Okay, then we have petroleum investment allowance. Petroleum investment allowance, PIA, 2,500. 2,500. Is that correct? Yes. So we've taken this, So what we're going to do, we're going to add them together. 20 plus 16 is 36, plus 2, 38,500. So this is on the one hand. Then you will say subject to or restricted to restricted to 85% of accessible profits. What is 85% of accessible profit? Accessible profit is how much here? 50,030. So 0.85 times 50,030. Look for 85% of it. 0.85 times 50,030. That gives me 42,526. 42,526. 42,526 less 170% of PIA. That's the formula for the restriction. So just memorize 85% of accessible profits less 170% of PIA. So this is 1.7 times 2,500. So 1.7 times 2,500. That will give me 42, 425, 4250. 4250. So when you less these two, so put a minus here, 42,526. That gives you 38,276. 38,276. 38,276. Now, what it means is that just like when we did capital allowances and we said capital allowance is restricted to 2/3 of, now this restricted means you cannot take more than this. So assuming this is the high, if this figure is higher than this, we will take the lower one because this is what was incurred. But now this one that was incurred is higher than the restriction. You cannot take more than the restriction. So we'll choose the lower. Choose the lower. So the lower is 38,276. That's what we are taking. 38,276. So we'll come here. 38,276. That's our capital allowance. That's our capital allowance. 38,276. Remove it from 50,030. That will give us 11,754. 11,754. This is going to be our chargeable profits. So these are our chargeable profits. But we are asked to look for chargeable tax. Chargeable tax is going to be 85%. We are also told profits from petroleum exported or sold locally are taxable at 85%. Now, this is different from this 85 you did in your restriction. That one is 85% of accessible profits. But this chargeable tax is 85% of chargeable profits. So this is going to be 0.85 multiplied by 11,754. That's what we're going to do now. This times 0.85. 9,991. 9,991. So this is the tax you're going to pay. So normally this is your tax. You then bring down your tertiary education tax, which you are allowed, and you bring the value. This is another tax that you are going to pay. 1011. 1011. This is another tax. So you can imagine you pay. This is the other tax, 1011. You are paying 11,002 out of 11,754 as taxes. So you can imagine what the oil company paid to the government as tax, 85%. and most times it's billions. This is just to give you illustration. So, but for the case of education tax, even though they are paying it, they are deducting it as allowable deduction in order to derive this 9991. But in the case of company income tax, you don't deduct education tax. It means that the money you will pay for company income tax will be a bit higher. Your education tax is computed. So, but this one, education tax becomes an allowable deduction. So you've seen how we calculate taxable income or tax in a petroleum company.
I have a question, please.
Okay, ask your question.
Yeah, so this 85% taxable, we restricted the capital allowance to 5%. We also restricted the tax to 5%. Is it generally intended, or they'll give you in the
Generally, it
question?
is generally for all oil companies that are not PSC.
Okay, but it will be stated in the question, right?
They might not state it, they might state it.
Okay, so we should just know that when we are doing the capital allowance, if in the question we restrict it with 5%, we ignore the 2/3 that we usually do for normal
So we
capital
don't do
allowance.
thought. I just use that to thought just to show you an example.
Yeah, yes. So we ignore that one and we just go with
Yes, not
85%.
thought. But if it were to be a production sharing contract,
Yeah.
the allowance would be 50% of your, what do they call it, of your assets. And the tax is also 50%.
Okay.
So you need to know that.
Mm.
This is another one here. Okay. Let me see. Both of them are similar. Once you do one, you'll be able to do all the others. I want to see the one that has gas. They're all similar. Now, this is petroleum production sharing contract, what I was telling you. So this production sharing contract. I was trying to see one that has gas that they will give you. I think we'll be able to just take one from the question there and see how it is being treated.
I just saw oil and gas now. Question 3.
There was one that was treated here. Okay, let's look at this so that we know what to do. So this is a value of natural gas. Illustration. Okay, look at this illustration. Oriente Limited derives income from individual gas sales contracts as follows. And this is contract 1 from Adetolani Limited. Look at the gas factor, and this is the amount. So let me do it well here. This is load factor. Let me call this one LF. So this is degree. This is degree. This is degree. Then this is amount. That's a million, billion, and million. So the load factor is supposed to be in degree. Okay, is it in that's sorry. So now the load factor is in degree. So compute the income derived from the sale of gas. The load factor now. So what you do now is this. Let's look at rente. Rente Limited. What's happening to red? All right. Now look at the gas. Look at contracts. Contracts. These are the load factor. We call this of gas factor value in millions. Let me call this on AD. AD. Let me call this on AK. AK. We call this on W. The load factor 50, 75, 80. 50, 75, 80. We don't know the gas factor. 54, 4.8. This is 54, 4.8. And this is 2.4. All right, so we need to know the gas factor. How do we get the gas factor? So look at, they will give you a table of gas factor. Load factor, gas factor. The gas factor is in percentage. Gas factor, the load factor is in degree. Gas factor percentage. Right? So this is 50, 60, 70, 80, right? And this is 50. Now, because this is 50, we know it here is 16.9. We put 16.9%. Now, this is 70, 75. This is 80 is here. We know it exactly 13.6. This is 13.6. Now, there is no 75 here. We have 75. So what do we put here? So we'll do that one here. Gas factor for AK is found by interpolation. So we'll now say 75 falls between 70 and 80. So you say 70, okay, let's say 80, as the case may be, 80, which is a higher gas factor, minus 70, which is a low gas factor in that range, high, low. Now, we will now say 75 is even higher than 70. 75 minus 70. Now watch you. This is equal to, what is the figure? What is the gas factor for 80? 13.6. 13.6 minus, what is that of 70? 14.3. 14.3. What is that of 75? We don't know. It's X. This X we are looking for, minus that of 70 is 14.3. So now our aim is to look for X. So what do we do? 80 minus 70 is 10. 75 minus 70 is 5. Equal to, the denominator is still X minus 14.3. What about the numerator? 13.6 minus 14.3. That will give you minus 0.7. Minus 0.7. Now you cross multiply. How do you cross multiply? You cross multiply. This 10 that is up here will multiply this X minus 14.3 on the one hand. This equal to is this equal to here. This 5 here will multiply 0 minus 0.7. Now you have cross multiplied. Now this is going to be 10x minus 143. That is when you say 10 times 14.3 will be equal to 5 times 7 is 35. That is minus 3.5. Let's see. It's minus 3.5. Right? So what will happen? Let's take let's collect like terms. So anyone that is unknown will be here. So this is 10x.
Equals to
Yes.
minus 3.5 plus 143.
I didn't get that.
We are calculating together. I said minus 3.5 plus 143
Oh,
now.
minus 3.5 plus 143, right?
Yeah.
What would that give us?
That'll be
10x will be,
139.5.
say, plus 143.
139.5.
9.5, right?
Yeah.
So that will be equal to positive figure 139.5. Therefore, x will be 139.5 divided by 10, giving you 13.95. So you will come here and say this is 13.95. Okay, so what you will do now, you will now calculate. This is AD, this is AK, this is W. What is their value? This is 58 million. Let me take it from here again. How much was that? 54 million. 4 million. This 4.8 and 2.4. 4.8, 2.4. I say minus discount. Discount is, what's the percentage? This one is 19.5. I'll come here. Minus 0.1395 times 4.8. So I've looked for 13.5 of this. This is going to be the discount here. We got that one straight. This is 16.9. 0.169 times 54. Then this other one is 13.6. 0.136 times 2.4. Anything you get here is your value of gas. So let's see. Let's do the first one. There is always a shortcut for me. I'll do the two, I will do one and do the shortcut. Now this is 0.169 multiplied by 54. Right? 9.126. Anything I have, I'll minus it from 54. I'm getting 44.874. $44.874. Now the shortcut I wanted to do here is 1 minus 0.169. So if this is the discount, 0.169, this is what 83.1% is the cost value. I'll just simply multiply it by 54 and I get the same value. So that's what I'm going to do in this second one. I've demonstrated that it will give you the same thing. 1 minus 0.1395 multiplied by 4.8. I have 4.1304. 4.1304. Now just show that this other one, we can do it the other way we did before, so that if you want to choose which one to do, you can come and say 0.136 multiplied by 2.4. Any answer you get, remember all of this will have this negative value plus 2.4. That gives you 2.0736. So this is 2.0736. So this is the gas value. So you have a contract, 54 million. Now the value that you'll be chargeable is 44.874. That's depending on the gas factor. So that's how to calculate gas. So we need to do the gas and the petroleum, because in a question, you might see them in one question. So you will handle the gas contract like this and handle the other one. And when you calculate this gas factor, this is the revenue from your gas. So if you are doing a question that has gas with petroleum, after calculating revenue from petroleum, you need to calculate revenue from gas and add it together to get your gross income. So that's why I need to do this so that you know how the gas is being calculated. All right, so we have come to the end of our class for today. So feel free to look at questions, solve them. Feel free to share them with me so that we can discuss where you need help. That's been a very, very engaging and interesting class. And thank you so much for making this class a wonderful one. Once again, I'll say thank you.
You.